Evaluating performance based on average return alone is not very useful. Return must be adjusted for risk before they can be compared meaningfully. The simplest and most popular way to adjust returns for portfolio risk is to compare rates of return with those of other investment funds with similar risk characteristics. Risk-adjusted performance appraisal methods can mitigate the natural fixation on rates of return. It is widely accepted principle in investment management that investors are risk-averse. Risk-averse investors require additional return to compensate for taking extra risk. Therefore, performance measurements must take into consideration the corresponding risk taken by fund managers. In this video, we are going to learn how to calculate risk-adjusted performance and apply it in performance evaluation. Stay tuned. There are four portfolio performance evaluation techniques that comprise the basic toolkit for measuring risk-adjusted performance. First, Sharpe Ratio. Second, Treynor Measure. Third, Jensen Measure. Fourth, Information Ratio. These measures explicitly take the volatility of returns into account. In 1966, Nobel laureate William Sharpe developed a measure of risk-adjusted performance for portfolio called the Sharpe Ratio. This measure followed closely his earlier work on the capital asset pricing model. Sharpe ratio is also known as reward to variability ratio. The Sharpe ratio compares excess returns to the total risk of the portfolio, where total risk is measured by the standard deviation of returns. In other words, the Sharpe ratio considers the exposed risk premium earned per unit of total risk. How can we interpret the Sharpe ratio? It is important to take note that the higher the Sharpe ratio, the better the fund's performance. When should we use Sharpe ratio? Well, investors should use Sharpe ratio when they invest in treasury bills and one risky portfolio, when investor is not fully diversified and total risk is a concern. The Sharpe index for a benchmark can be calculated as the average market return minus the average risk-free rate, then divided by the standard deviation of the market. The Sharpe index for a benchmark can be pictured via the capital market line, which represents a trade-off between the risk and expected return. In the figure, RFM is the capital market line, and M refers to the market portfolio. The benchmark of the portfolio Sharpe ratio is based on the exposed capital market line. Portfolio P outperforms the market benchmark and its Sharpe ratio is higher than the capital market line. Even though the return of portfolio Q is the highest, its risk is relatively higher too. Portfolio Q underperforms the market benchmark and its Sharpe ratio is lower than the capital market line. A skillful manager will produce returns above the capital market line. Now, let's have an example to practice how to calculate the Sharpe ratio. I'm sure you can do it. The formula for Sharpe ratio is return minus risk-free rate divided by standard deviation. You need to calculate the Sharpe ratio for the market as well as portfolio D, E, and F. For example, Sharpe ratio of portfolio F is 0.16 minus 0.08 divided by 0.23. Let's try. Here is the final answer. I hope you got it correct. Next, we are going to learn about the second risk-adjusted performance measure by Jack Treynor in 1965. Treynor developed the first composite measure of portfolio performance that included risk. The Treynor measure is also known as reward to volatility ratio. Implicit in the Treynor approach is the assumption that the portfolio managers can diversify away unsystematic risk, and only systematic risk remains. Treynor's measure gives excess return per unit of beta. How can we interpret the Treynor measure? Well, the higher the Treynor index, the better the fund's performance. When should we use the Treynor measure? Investors should use the Treynor measure when they have an actively managed or adequately diversified portfolio where unsystematic risk is no longer a concern. The Treynor index for a benchmark can be calculated as average market return minus average risk-free rate, then divide by the beta of market portfolio. As beta of a market portfolio is equal to 1, the formula can be expressed as average market return minus average risk-free rate. The Treynor index for a benchmark can be pictured via the security market line, which represents the trade-off between beta and expected return for managed portfolios. In the figure, RFM is the security market line, and M refers to the market portfolio. The Treynor measure uses the exposed security market line to form a benchmark. Portfolio P outperforms the market benchmark, and its Treynor ratio is higher than the security market line. Even though the return of portfolio Q is the highest, its risk is relatively higher too. Portfolio Q underperforms the market benchmark as its Treynor ratio is lower than the security market line. A skillful manager will produce returns above the security market line. Now let's have an example to practice how to calculate the Treynor ratio. I'm sure you can do it. The formula for Treynor ratio is return minus risk-free rate, then divide by beta. You need to calculate the Treynor ratio for the market as well as for portfolio WXY. For example, the Treynor ratio for portfolio W is 0.12 minus 0.08 divided by 0.9. Let's try. Here is the answer. I hope you get the answer correct. The higher the Treynor ratio, the better the performance of the fund manager. Next, we are going to learn the third risk-adjusted performance measure by Michael C. Jensen in 1968. The Jensen measure was originally based on the capital asset pricing model. The Jensen measure is also known as Jensen's Alpha. Jensen emphasizes using certain aspects of the capital asset pricing model to evaluate portfolio managers. Jensen's alpha calculates the excess return that a portfolio generates over its expected return. How can we interpret the Jensen's alpha? Well, the higher the Jensen's alpha, the better the risk-adjusted return is. When should we use the Jensen measure? Well, investor can use the Jensen's alpha when the portfolio is already diversified. In the figure, the security market line represents the benchmark based on the capital asset pricing model. Portfolio M is a market portfolio with beta of 1. Portfolio A is above the security market line. It has a positive alpha. Portfolio A outperformed the expected return based on the capital asset pricing model. On the other hand, Portfolio B is below the security market line. It has a negative alpha. We can conclude that Portfolio B underperforms the expected return based on CAPM. In this example, we first use the CAPM to calculate the expected return of portfolio X and Y. For example, the expected return for portfolio X is risk-free rate 5% plus beta 0.7 then multiply with 13% minus 5%, and the answer is 10.6%. The expected return for portfolio X based on the CAPM is 10.6%. However, the actual expected rate of return for portfolio X is 13%. Therefore, the Jensen Alpha is equal to 13% minus 10.6%, and the answer is 2.4%. You may repeat the same process for portfolio Y too. I hope you will try and get the answer correct. I have included a little final answer below to motivate you to try. Finally, we come to the fourth risk-adjusted performance measure, which is known as information ratio. The information ratio is also known as appraisal ratio. The information ratio divides the alpha of the portfolio by the non-systematic risk of the portfolio, which is also known as tracking error in the industry. It measures abnormal return per unit of risk that in principle could be diversified away by holding a market index portfolio. How can we interpret the information ratio? Well, the higher the information ratio, the better the risk-adjusted return is. When should we use the information ratio? Investors should use information ratio when the stock is mixed with a market index fund, or this is from an actively managed stock portfolio. The formula to calculate the information ratio can be expressed in two ways. In the first formula, the nominator is the average return of a portfolio minus the average return of a benchmark, which is equivalent to the alpha in the second formula. The denominator is the tracking error, which is the standard deviation of the residuals from the market model. Both formulas mean the same. They are just being expressed differently. Let's practice how to calculate the information ratio. For Fund Manager A, the alpha is 13% minus negative 1.5%, which is 14.5%. Then we divide 14.5% by tracking error of 8%. The information ratio for Fund Manager A is 1.81. You can repeat the same calculation process for Fund Manager B. Fund Manager B has better performance as its information ratio of 2.11 is higher. To have more practice, I would encourage you to try this example from the Bodhi's textbook, page 823. The four performance measures are based on mean variance framework. This requires the distribution of returns be fully explained by mean and variance. If the distribution of return is non-normal, as reflected in skewness and kurtosis, the performance measures may have limitation. For example, investment A and B has the same probability distribution. The returns for both investments are the same under normal scenario and recession. However, investment B has higher upside potential of 76% during boom. Investment A has higher Sharpe ratio. So based on Sharpe ratio, investment A performs better. However, this is in contradiction with common sense, as B should be selected. I hope you have learned something from this video. See you and goodbye.